Welcome. Thanks for taking the time to listen in today as I explore a few tax planning opportunities in the lead up to the end of June 2021. My name is James Northcote. I'm a principal in our business advisory division of William Buck in Adelaide. Now, I do need to apologise in advance. Tax is unfortunately a dry topic. I can't change that, but hopefully I can give you some idea of what we look at for our clients here at William Buck, not just annually, but all throughout the year and across multiple years as well. So for many of our existing William Buck clients, we've been tax planning with them for many years, and they've received the benefits that planning has to offer. But often, new clients to our firm have not been exposed to this and not been exposed to the planning options available to minimise tax payments in both the short and the long term. I've listed here on the screen a few of the key items that I want to run through with you today. Depreciation is the first one I've listed there. There's been huge changes this year. The measures announced in the October 2020 budget have now been proposed to be extended by 1 year out to June 2023 as a result of the May 2021 federal budget. And as the 2021 financial year comes to a close over the next month, now is really where we start to investigate the impacts of the budget announcements with some realistic trading results. The loss carryback measure is another new measure applying to companies, and I'll also spend a bit of time on that today. And at the second half of this page, I've listed a few other items that, whilst they're not specifically new, I do want to explore with you how they might be used this year and how it might be different from prior years, given the large changes with those first two items, in particular depreciation. Depreciation will take up a reasonable amount of time in this presentation today. I'll spend some time on the rules themselves, some choices available, and how this might impact your business. I should highlight that this topic covers depreciable assets like cars or items of plant like a forklift or a tractor or a header, potentially computers and IT equipment, but it doesn't cover buildings. A number of changes have been made in this area over the past year. Some of these are quite complex and are applied dependent on turnover. I've therefore split this section between those businesses with turnover of less than $10 million and those who are over 10 million. The reason for that is the $10 million turnover threshold is the magic number to determine whether you are a small business entity or not. Now, we're talking about aggregated turnover here. So for those not aware of aggregated turnover, this effectively means that any business that you own or have a strong influence over, their turnovers will be grouped together. So two entities, each with $8 million in turnover, will therefore have an aggregated turnover of 16 million, and you would not be a small business entity. So if your turnover is under $10 million, you are by definition a small business entity. Being a small business entity then provides the choice as to whether you apply small business depreciation rules or not. In most years, this choice doesn't have a major impact on your tax payments, but for 2021 financial year, it will. Now, if you're not using the small business depreciation rules, you have the choice to write off all of the assets that you've acquired during after 6th of October 2020. You can choose to write off no assets immediately, or lastly, you might choose to pick on specific assets and write those off, and other ones you might write off under normal capital allowance rules. If, on the other hand, you are using an SBE depreciation pool, your tax could be impacted in a major way due to the provisions that require the whole SBE pool balance to be written off. All new assets acquired and any remaining value of existing assets already in the pool will end up being claimed in full in your 2021 tax return. Without taking any action, additions to the pool will also be written off in full in the year that they're required. I list at the end of this page that there's a choice to make around whether your business exits the SBE pool, but that will only stop new assets from being deducted in full. Any assets already sitting in that SBE pool will be written off in full in 2021. Now, when I talk about SBE pools and thinking of my own client base, I have two clients that come to mind. Their turnovers are each under $10 million, and they both have depreciable assets of about $4 million, but a profit of about $2 million annually. And these entities typically have used small business depreciation in the past, and so they will be required to record a tax depreciation claim to the tune of $4 million. That will therefore give them a tax loss for the year and likely no tax payments for the next even 2 to 3 years. One of these made a significant capex investment in 2021, so we'll need to work through if there are any suitable options for them to reduce or to manage is the better word, manage their tax payments. Now, for larger business with a turnover of greater than $10 million, there are still some very lucrative depreciation measures available. These measures were designed in the October 2020 federal budget to encourage business investment, particularly on new capital items. And for the majority of new capex spend, an immediate deduction will be available for the business. Now, there's a couple of thresholds to keep in mind here. There's a new asset threshold of $5 billion of income or turnover. So if your turnover is greater than that, which won't be a problem for too many people, if your income is over that $5 billion mark, you don't get the benefit of these rules. But for the vast bulk of business I work with, their turnover will be well below the $5 billion, and therefore any asset they buy will be eligible for an immediate tax deduction. There's also a threshold there for second-hand assets. So if your turnover is less than $50 million, which again, most of my clients will be, they will be able to claim in full any cost that they've incurred on second-hand assets. Now, I do need to highlight that these assets, if you've bought them after October 2020, the asset must be installed and ready for use before 30 June 2021 if you want to make that claim in 2021. Now, any asset that you might have acquired before October 2020, they'll be subject to existing depreciation rules or capital allowance rules, they're often called, which might mean they're claimed over 5, 10, 15 years or whatever the appropriate rate is. It is possible under this method for you to pick and choose which items you write off in full. Now, you may choose to write off small items like a computer or some furniture, but you might keep the larger pieces of machinery that you claim over its normal useful life and therefore spreading the depreciation benefits over a number of years. So I've explored so far what the changes are. Now I want to focus on how they might impact your business. The major impact, of course, is that we have a substantially reduced tax bill now due to the higher depreciation claims, and that's great. But I also want to talk about and highlight some of the unintended or potential impacts if this one-off benefit is not managed effectively. Now, I should just stop here and highlight that none of these potential impacts are showstoppers. So if there's an immediate depreciation claim there now, we're more than likely going to take it anyway and be happy that we've got it. But it's more so being aware that there are potential impacts, whether they're realised now or in the future, and that allows us to plan appropriately. So just running through this list a little bit, where we sell an asset that we've claimed in full, we'll have a recouped depreciation amount, and that will then fall in income in a later year. Dividend payments could be impacted, particularly those where the company is perhaps newer and either they've got no tax to pay or what potentially is worse, there's actually no tax credits to accompany the dividend. And that could lead to some real mismatches. Trust profits, similar type of scenario. If there's no taxable income to distribute this year, there might be in a future year, and it might be taxed at a 47% penalty rate. So again, really important that we plan appropriately. Individuals, I won't talk about this piece now, but I've got an example later that highlights why that's important. And also bearing in mind future owners or future successors to the business. If the current owners are claiming all the depreciation, then the future owner may have very little or no depreciation, giving them higher tax payments in future. And hopefully as part of their due diligence, they'd be aware of such a scenario. Over the next few slides, I'm outlining just a fairly basic but equally quite probable example for business that could pop up over the next couple of years. It's designed to demonstrate how changes to depreciation rules could impact tax payments. So the first option at the top of the page, or that first table there, is where we claim all the depreciation benefits that are available to us. The second table at the bottom, we'll be running through an example where we don't claim full depreciation expensing measures and just use the existing depreciation rules. And just, I suppose, a bit of background to this example. It's designed to cover a scenario whereby we've got a trust with 4 beneficiaries, where depreciation, we're claiming the applicable amounts accordingly, and where the business makes, say, $500,000 profit each year before claiming depreciation. And they've also made a significant capital investment in 2021. What I do want to highlight on this first slide is that in 2021, where we've spent the money under that top part of the table, our adult beneficiaries pay no tax. We've got no taxable income, we therefore pay no tax. If we use the existing depreciation rules, then our individuals attached to the business would be paying a touch under $31,000 of tax. If I move across to year 2, following, again, keeping this example going, where under one method, we claim all the depreciation benefits that are available, and under the second, we use, I suppose, our existing depreciation measures. The tax payments in year 2 are very similar. There's only about $3,000 between the two scenarios where individuals have to pay tax. Now, the third year is where it actually gets a bit interesting, because under the scenario where a business claimed all the new capital investment in 2021, come 2023, they've actually got a massive tax bill, $135,000. Now, if that same business decided not to claim everything back in 2021, they'd only be paying about $31,000 in tax. So $100,000 difference in year 3, just through how depreciation measures work, could be a tough pill to swallow. Now, combining those 3 years together to give us some totals. Now, just before I speak through this anymore, it's just to reiterate that this is a very basic example, and it's really here to highlight and show the impacts that a lack of considered advice can have on your business. So across the 3-year period here, there's about an extra $70,000 in tax if the business just rolled along taking the depreciation rules as they came and as they were announced, and where we spent no time planning how we might work our way through this. I should highlight that whilst we're paying an extra $70,000 in tax, we've earned the same profit across the 3 years of the $600,000 each year. So same level of income, but paying an extra 70 grand in tax. Not sure I'd be too happy about that if that were me. So really the key point is here, spending a bit of time with your accountant early to plan through what this might look like could save your business a substantial amount in a very short space of time. So I want to talk through, okay, we've got these depreciation rules that impact on us, where we get a big claim now, and maybe we don't have anything, too many options available. We have to claim the depreciation, or maybe we want to just because we know that we could really use the tax deduction. So what I've listed here at the top of the page are 2 items that are widely used in practice as a means of ensuring non-working family members receive an income annually, or potentially to top up those family members who are working in the business in a low profit year. And I would hope that your accountants are already helping you with these strategies so that each year people are paying a small amount of tax. What these measures are designed to ensure are that tax payments are smoothed out and reduced over the longer term, as was shown here. So avoiding this 70 grand of extra tax. I do want to explore further though a new measure that was announced last year, and that's the loss carryback offset. And then also briefly talk about inventory valuations, and just for primary producers, a brief chat about farm management deposits. So the loss carryback. So for those with longer memories, we had a loss carryback regime probably about 10 or 12 years ago. I think it was only in place for about a year or two. And unfortunately, it got scrapped just as quick as the legislation was introduced. So to highlight how this scheme works, just as an example, if my business paid 50 grand of tax in both 2019 and 2020, I then follow up with a loss in 2021, I could potentially claim back that 100 grand of tax I paid over 2 years if my loss is large enough and I've got sufficient franking credits available. It's important to note that my tax loss could have been made through difficult trading conditions, but equally and probably more likely this financial year, the loss could have been generated solely through the large depreciation claims we discussed earlier. Now, this could represent a huge short-term cash flow benefit and boost to the business, where we've just spent quite a bit of money on capex. I do still need to caution though, that's only a timing issue. So even though we save the tax now, there will be higher future tax payments to come in years to come. Inventory. Now, some might think, why are we talking about this? But for me, inventory and valuing inventory is really useful because we have 3 methods available for tax purposes. And they're listed at the top of the screen here. So we've got cost, market value, or replacement value. And typically cost is lower than either market value or replacement value. And in normal years, the vast majority of my clients will value their inventory at cost for tax purposes, because being a lower value, my clients would rather defer their tax to a future year. Now, in this current year, 2021, we might require some thought as to how we value stock, taking into account each business' unique circumstances. So these inventory valuation measures most likely benefit trusts and partnerships. Companies can use inventory valuations as well, but the benefit for companies is somewhat limited due to the loss carryback measures being available. At the end of this page, I go through and summarise the key benefits of why we might look at this. So the first one being looking to use averaging out our incomes to avoid high tax payments that we can see on this screen, the one that we looked at earlier. Remember that 70 grand of extra tax because we didn't plan our way through. And the last comment I have here is about utilising low tax rates. So the thing with these, with marginal tax rates for individuals, is that they're available only annually. So it's a bit of a use it or lose it policy. So if there's an individual, he or she can earn $20,000 per year and pay no tax. In a similar manner, an individual can earn about $90,000 a year and pay the same amount of tax as you would inside a company. So managing and using low tax rates annually can prevent some very large tax bills in future, such as this one. Farm management deposits. I won't spend too long in this topic because any farmer or primary producer who's listening, I imagine will know all about this. But what I do want to talk about with this slide is that 2021 might actually be the financial year where we choose to withdraw some of your FMDs or all of them to counteract the large depreciation claims that might be available to this year and that we discussed earlier. The aim being, of course, to utilise the low marginal tax rates for individuals and reduce tax payments across the family group. Now, the next topic I want to run through fairly briefly is superannuation. So as many know, super for your employees is 9.5% right now. As of 1 July, that will increase to 10%. And annually thereafter will increase by 0.5% per year up to 12% of salary and wages. Now, I should highlight that accounting packages, their cash book programs are updated regularly and will be able to handle this change. But if you, as an employer, negotiate and arrange and design employee remuneration packages, you need to be aware of this change so it doesn't impact your bottom line further. Now, I have also listed some of the rules around concessional contributions or tax deductible contributions, currently $25,000 per person, but are scheduled to increase to $27,500 from July 2021. And then non-deductible contributions. So this is money where you've already paid tax and where you can't claim a tax deduction. You can contribute $100,000 into super, and that's scheduled to increase as well. So it's really important to spend some time with your accountant planning through your business taxable income, what measures might be available around super in this case to help manage your tax burden. A couple of other measures listed on this screen here. I won't discuss in detail today, but I find they're useful because in the context of this session today around tax planning, which is the third dot point here, are looking at unused concessional contributions. So if you're someone who hasn't contributed to super in the last couple of years and your super balance is less than $500,000, you might be able to actually catch up some of your contributions. So really important here that you do talk to your accountant or financial planner about about superannuation, because each circumstance is unique. And what could be of benefit here is that if you haven't contributed the last couple of years, you could contribute a larger amount this year. Now, if you've had or will have a big year in terms of profitability, this might be a wonderful way to not only save for retirement, but reduce your tax burden. Again, I'll be fairly brief on this page, but just to highlight some of the tax rate changes for individuals. So I've highlighted in green where those changes will apply from July 2021. So the first section there is the $18,200 to $45,000 bracket. That will be the new rate for 2022 financial year, because in 2021, $45,000 topped out at $37,000. So broadly, we get to earn more income and pay a better rate of tax. And I should also highlight that those individual tax rates are forecast to change further in future as well, where that 37% bracket, which is going to be that $120,000 to $180,000 income range, that's scheduled to disappear in a few years' time. And perhaps the last point that I want to cover, talking about tax rates, are that when we're paying out dividends from companies, the level of top-up tax is actually increasing a little bit from what it might have been in years gone by. So a company currently pays dividends at 26% franking rate, but quite often individuals are paying tax at 34.5%, including Medicare levy. So there's probably an increased top-up tax level that hasn't been there in years gone by. All right, we're almost there. Now, a few comments that I want to leave you with today. So importantly, in the lead up to June 2021, end of financial year, I would suggest that you walk away, if you can walk away, challenge your accountant to ensure that they know how depreciation will be claimed by your business in the 2021 tax year. Hopefully they're doing that planning as we speak. It's important to know how the depreciation rule changes could impact your business in future years and the tax payments that you would be making in those years. And importantly, your accountant needs to be communicating this with you so that they're clear on what's happening and you're clear on what's happening as well. And then as a separate measure to that, once we've understood depreciation, is to see if there are any other measures available to your business to help manage tax for the longer term. And again, as we talked about earlier, inventory valuations, super contributions, or paying out profits from beneficiary companies. I do have to put a disclaimer in, just because essentially saying that I'm not giving you personal advice. Please talk to your accountant and seek further advice, or alternatively, have a chat to me. My details are on the screen. If you have any questions that you'd like to follow up from this paper presentation, please do so, whether by phone or email. I'd love to hear from you. I hope you found this session useful today. Really hope you get something out of it, and good luck with the planning towards 30 June 2021.